The trend is your friend. It's classic trading wisdom you could bank on through a raging bull market. But what do you do in markets like today where lasting trends can be hard to come by? Well, day trader Jordan Fogel says he's found an answer. He says his trading strategy has helped him stay profitable through these uncertain markets. So let's find out how he's spotting grade A setups in the midst of all this volatility. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing and trading skills. Presented by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. We've got an interesting deep dive into a novel trading strategy called the triple line method. Its creator, Jordan Fogel, says it's helped him win 65% of his trades and become consistently profitable over the past few years. So we're going to hear all about his tricks of the trade in our conversation today. Plus, we're going to take your questions on all things day trading in our Q&A session, so stay tuned for that. For now, though, let's get into it. Joining us is Jordan Fogel, founder of Freedom Team Trading, a community for day traders looking to escape the grind of the 9 to 5. Jordan, fantastic to have you with us here. Appreciate you taking the time.
Thanks, Rob, for having me. I'm excited. Yeah, excited to get into it.
Right on. I have to say, Jordan, you are not the stereotypical Wolf of Wall Street-esque day trader that some people might have in their minds. You got started full-time day trading really early in life. You're only in, your mid-20s here? How did you get into day trading? Tell us about your backstory.
Yeah, it's a short story. So, my first job was always at Bed Bath & Beyond. I was a cashier. And it's funny, it ended up becoming a meme stock, but that's a different story in itself. But yeah. First shift, it's a 3-hour shift, and I get back after it, and it was awful. I remember just going out there. They basically had me do nothing, just like, if a customer came, just ask someone else for help, just make sure everything looks neat. It was awful. It was so boring. I went home, and I said, there's no way I could do this, right? It was my first real experience at a job. And I said, there has to be a way for me to not do this the rest of my life. I said, people work 8 hours a day doing stuff like this the rest of their lives. There's no way. So I went online. I go home. And I look up how to make money, like in high school as a teenager online, like quick, fast, right? Like a lot of people have done that. And of course, there's a bunch of scams, all this random stuff coming up. But then I see a video of someone day trading, and it's this guy on his computer. He's just like sitting in his office like this, and he made like $2,000 in like 30 seconds. And ever since then, I was hooked. I was like, if this guy can sit here and make $2,000 in 30 seconds from his computer, and I'm at my job making $12 an hour, I was like, there's no way I could do that. And that kind of started the journey of me getting started in trading about 8 years ago.
Now, did you start more part-time? I know that's how a lot of people start, and then they kind of shift into full-time, or did you just go full bore right into it, like this is my life now?
No, I started in high school. So I started very young. I had to use my parents to get a custodial account to even trade. I learned all about it. I only had like $1,000 at the time. So definitely not full-time to start. So I started literally, I had to switch my schedule in high school because the market opened at 9:30. I had like a free period, and I moved it to it was like 9:20 to 10:10. So I had like a nice 40-minute slot right after the market opened. I'd go to the library and I'd start trading. So very part-time, to not become full-time for a while, and eventually did, but was not start out that easy.
I got to say, man, I was doing much less productive things in high school than you were here. So kudos to you. That's awesome. And you're like a young veteran now, right? At this for several years now. We've seen tariffs rattle investor sentiment, spark a lot of market volatility. Traders maybe not sure what exactly they're supposed to do here. What are some of the key lessons you have for them that can kind of help them succeed through these, challenging conditions?
Yeah, the biggest thing for me is to not change anything. Right. It's very easy to get scared. It's very easy to freak out when the markets crash, when tariffs happen, when you're unaware of what's going to, predict in the market. But, nobody knows what's ever going to happen in the market. And so for me as a trader, I know the best way for me to continue making money is to simply keep doing what I'm doing. Right. The market's not going to, the price action is still going to stay the same. Buyers are still going to buy, sellers are still going to sell. Nothing is going to change. And the same patterns that I've been using to make money are still going to be there. They may be a little less frequent or more frequent or in different areas or different stocks, but the patterns are still going to be there. So the best thing you can do is keep doing what you're doing. If you're a long-term investor, just buy when it dips. And if you're a trader like me, you should have a strategy that just works and just keep doing that over and over again.
All right, well, speaking of what you're doing, let's get into the heart of our conversation here. This is your day trading strategy that's helped you become, You say consistently profitable with a high win rate. And for those in our audience too, if you want to get in on this conversation as well, we'd love to have you. So make sure you submit your questions for Jordan. If you're watching us on WebBroker, you can use the chat box there to send questions in. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, you can just click on the link in the description. It's going to pop you over to our broadcast platform. That's where you can ask your question. All right, Jordan, so we've got some charts here that we're going to speak to here that are going to help you illustrate what you're doing. But before we dig into that, just tell us about the nuts and bolts of your day trading strategy here. Like at a high level, how does it work and what's the rationale behind it?
Yeah, I mean, to explain it in a simple way, you can kind of call it like a mean reversion strategy, right? And so there's always going to be prices in a market or in a stock that's considered, fair value. And that's when you have an equal amount of buyers and equal amount of sellers, right? And so when that happens, price is very choppy. It's going up, it's going down, it's back and forth. There's no clear direction. And so where the edge kind of comes into play is that, let's say one side starts to dip. So let's say, for whatever reason, there's a huge point of supply and price just dumps, right? And you have a bunch of sellers coming in. For whatever reason, there's not a lot of demand. And you would expect selling to keep happening. But then, for whatever reason, that doesn't happen, right? Whether it's an outside factor, whether it's some institutional player who comes in and starts buying, they dig it up, price starts to return back higher, and that's kind of where the actual edge comes into play. So when price goes back into that fair value area, where there's an equal amount of buyers and sellers, there's a high probability that price is going to rotate to certain other levels in the market. And that's essentially what I do. I look for those areas where there's a high probability that price is going to go to another area. And that's simply it.
And so your triple line method here is kind of how you're doing this. Can you talk us through what is this triple line method? What are you looking at? We actually have a chart here. It's called case study here for our folks on screen there. Give us this little walkthrough of what we're seeing on screen here, Jordan.
Yeah, for sure. So triple line method just is a broken down way, a simplified way to trade my concepts of strategies, right? This chart isn't actually triple line method, but this is a good idea of what's happening, right? So you can see right there on the left, you have these two blue levels, right? One of them is at the top, one of them is at the bottom. So that's what we call a balance zone, right? It's when price is in between both of those blue levels. That's considered fair value. So you can see what happens is, in this example here, price starts to dump below that. And so what's happening? Everyone who bought within that fair value, they're now trapped, right? They see price dump below support. A lot of classic traders are going to sell at that moment. At the same time, you have intraday traders who are shorting that move, right? Price is breaking down, supply is increasing, so they're going to initiate shorts, which means you have a bunch of selling going on. You have a huge amounts of selling, which you would expect price to just dump and just go down and down and down. But you can see what happens right here is that it actually starts to reverse back the other way. Sure, it dumps down a little bit, but something is happening in this moment, right? Whether it's institutions coming in, you have other buyers coming in, whatever it is, price is starting to go in the other direction. And you can see, in the green arrows there, shorts, when price goes up, they have to stop out because now they're starting to take losses, price is going up, and they have to close their positions. And when they close their positions, they are going to buy, which is going to drive price higher even more. So again, looking at this chart, when price gets back above that blue level and we get back inside that fair value area, price is going to go right to the other side, right up to the other blue level, and that's exactly what it does. You can see, this is over it looks like a 2-month chart. All the way back on the right, it happens again, right? Price dumps back below that blue level. What happens? You would expect a bunch of sellers to come in. Price should dump, but it doesn't. There's something going on there. We get increased volume, a few other indicators, right? And then it goes right back up into that fair value. And what does price do when it's in fair value? It bounces around. It goes up, it goes down, but eventually it goes from one side all the way to the other. And eventually it made itself back to the other side of that blue line and then just kept ripping higher. So if you can understand how buyers and sellers interact, who's actually moving the market, you can essentially make understanding of what's going on in the market using simple graphics like this. And again, the triple line method is just a very simple way to trade this. The actual concept itself is what's very important. And if you can learn that, you can make money in the markets, no matter the market conditions.
So I always look at these day trading charts, these strategies. In retrospect, it looks so obvious, but in the moment, it can obviously be very hard to figure out where that zone is. How are you figuring out where that zone is?
Yeah, it's a hard because I wish I could give you a simple answer, but really over the years of trading, I've just been able to identify it by eye. But the easiest kind of way, if I were to simplify it and make it like an easy step by step for you, you really just want to look for classic support and resistance, right? If you see an area where price goes up to it maybe one time, two times, three times in a row, and then it keeps going down, that's going to show you that, hey, there is a abundant of sellers who are willing to sell at that price. So that's going to create that boundary of where price is considered fair. Same thing on the, the buyer side. If we have just a lot of buyers coming in at that same exact level, you're going to basically figure out where those buyers are going to come in. And then you can kind of create that reference off of those support and resistance levels. And again, I want to make this clear because a lot of, people just trade support resistance. Balance theory, triple I method does not support resistance. It's a completely different concept, so I don't want to confuse the two, but you can kind of interchange them and use them to help each other out.
And what else are you looking for when you're tracking this balance zone, if you will? Like, what are some of the other indicators that you're looking for on your charts?
To be honest, I don't really use any. I mean, another one you could use is volume profile. So that one basically just shows where price has been over time. And the real thesis and theory behind this strategy and why it works is all based off time, right? So if I know that price is comfortable spending, let's say we're looking at Apple, for example, and it's in between $100, $105, and it stayed in that range for 2 weeks, that's a long time to stay in that range. Whereas let's say Apple then dips to $85, but it only stays in that $85 range for 2 hours and then immediately goes back up into the 90s. That tells me a lot about what's happening in price. It tells me that in that 85 area, there's a lot of aggressive buyers. Price doesn't like to spend a lot of time there. And whenever price goes down there, you have people immediately being aggressive. They're buying on the ask. They're being aggressive, getting a lot of orders in. Versus when price is in that 100 to 105 range, if it's just been in there for 2 weeks, well, it's a fair market, right? So there's not a big edge in that area. So it's really just looking at time and looking at volume and price. That's all you need.
I'm wondering if you can walk us through a step-by-step approach to how you're doing this. We have 3 charts here that we can show up here. So let's start with step 1 here. Talk us through what we're seeing, and then we can move on to step 2 and step 3 here.
Awesome. So step 1, so this is the triple line method, right? So basically what it does is it turns this theory into a day trading strategy, into a day trading lesson. So what it does is it auto plots these levels on the chart every single day for every single stock. So right there, this is an example showing all the levels. And that's essentially all you need to do, right? It's going to plot those levels of where fair value or fair balance is. If you're able to go to the next slide here, I can show you basically how you'd want to trade it. So there you go, step 2, right? Once you have your levels, you only look at the previous day's levels. So you basically just change the indicator. So it's going to draw all the levels out, only show you today's levels, and then you're good to trade, right? And so you can see essentially how this works, right? You have your top level, your middle level, and your bottom level. Now, for this, you don't really need to worry about the middle, that purple level there. It doesn't really matter. What matters is that fair balance zone, which is in between those black levels. So in this example right here, as a day trader, right? Price opens above that black level or above both of those levels. So which means we're opening above fair value. Now, again, the way the strategy works is I don't care what happens if price is above that level, right? I care when price gets inside of that level, when price is inside fair value. So you can see what happens. Price kind of stays for the first 30 minutes. Eventually it dumps back below that black level. Now that tells me we are now inside of a fair value range, right? Because these levels are based off yesterday's fair value. So I now know when price gets into that area, there's an equal amount of buyers and sellers. And so what does price do? When we're inside fair value, there's a strong chance we're going to go to the other side. We're going to bounce around, and it's going to keep figuring out where price wants to go until one side gives up. You can see in that picture right there, price just goes straight down to the other level. And once you're there, the trade is pretty much done, right? I don't really care what happens after that. I got lucky that it just bounced and went straight up. But that's really all there is to it. And that's, basically the triple line method in itself. I don't really know what slide 3 is.
Let's see slide 3. Let's see what we're speaking to.
Yeah.
There you go.
So boom, you can see price goes into that fair value. Price definitely goes down back to that other line. And there you go. And once price goes from line to line, the trade is done, right? I'm not sitting here as a trader taking a million trades. I'm not looking for a million moves. I'm looking for my edge. And I know that in that fair value area, that's where this can happen. So I basically just wait for price to go line to line. I get in, I get out, and that's it. It's really how simple it is.
And give me a sense of like, what does an A plus setup look like for you?
Yeah, I mean, A plus, I have a lot of, the same strategy, the core components is the same, right? So I'm trading fair value, I'm trading those levels. But there's a few other things that I look at that make it an A plus setup. Now, you can call them confirmations. Some people call them flashlights. Doesn't really matter. But they're basically extra levels of protection that give me higher confidence in those setups. So for example, right, A plus setup, you would need, the first thing is like this setup needs to happen. So price needs to go into that fair value levels, right? Another confirmation would be volume, right? So when price goes outside of that fair value, do I see an increased volume and then price start to reverse? That's going to be another confirmation, right? A third confirmation is going to be the levels themselves. So if I'm looking at yesterday's price action, let's say yesterday was just a ripper. Price just went straight up the entire day. It was a crazy day, it just went straight up. I'm not going to want to trade the next day because price wasn't fair the previous day. Price was just straight up. There's a straight imbalance, so many buyers, not enough sellers. And so it's going to be hard to figure out where price is going to go in the next day. So those are kind of like three of the confirmations I look for. And the more confirmations you have, they start to stack up. That's going to give you an A plus setup. So for me, if I get anywhere from three to four, that's an A plus. If I see one or two, it's like a B setup, probably not enough for me to take the trade.
Right. And then I'm just curious, so you're talking about watching the stock movement over a period of time. What is that period of time that you're studying the movements of a stock to realize, okay, this is probably the fair value range or not?
Yeah, that's a good question. So it depends on the time frame you're looking at, right? And I look at time frame a little bit different than most traders. But for example, if you're looking at just triple line method, TLM, you don't have to look at anything, right? You're only looking at the same levels in the previous day. So it's a 1 day, 2 day horizon you're looking at. Now, if I'm trading the same strategy over a swing trade, over a 1 week trade, 2 week trade, whatever it is, then I start to zoom out, right? Because I want to know what's going on in the higher time frame context. I want to know if, in the past year, are we in an uptrend? Because if we are, I'm not going to look to get in any shorts, right? Even if in the short term, there's a good, A plus setup that, is biased towards shorting, it doesn't matter. If the long-term trend is in an uptrend, I want to have that higher time frame context. I want to be able to have alignment in the short-term trading with the long-term trading. And this goes for both ways, right? If I'm trading, let's say, again, a 2 week trade, I want to make sure in the monthly, in the 6 month out, and the 1 year out, I'm in the same time frame. And sometimes I'll even go as much as, if I'm day trading and I'm looking at the 1 minute chart, I still want to make sure there's nothing in the 6 month out, 3 month out, 1 year out timeline that I need to know about that could cause a massive issue. Because the higher time frame always wins, right? If I'm an institution, I have millions of dollars, I'm looking to get into a trade, right? I'm going to be buying in certain areas off the higher time frame. And so that's going to be a key indicator when I'm looking at basically how far off I should trade.
Okay, really interesting stuff. Appreciate you giving us a peek behind the curtain there in your strategy here, Jordan. We got a lot more to get to here, but before we continue, just to our viewers out there, if you're enjoying what you're seeing so far and you want to learn from more traders and investors like Jordan here today, make sure you follow TD Direct Investing on our socials. We're on YouTube, we're on Facebook, we're on Instagram. You can check us out there. You can get a sneak peek at upcoming episodes. You can also get a ton of other educational content that's going to help you build your investing and your trading knowledge over time. So make sure you give us a follow here. All right, Jordan, I want to pick up on what you're experiencing here today with your day trading strategy here. With this higher volatility we're seeing, how has your strategy been working? Has it been working business as usual? Is it better or worse? Give us a sense.
Been working the same as it always has been, right? That's what I do. I have my setups and I trade. Now, the real only big difference I would find is that when there's increased volatility, I will typically do more day trading and less swing trading. And swing trading just means overnight trading, 1 week out, 2 week out trades, just because it's so crazy, right? It's harder to predict what's going to happen 2 weeks in the future when there's just Trump and tariffs and everything going on. Intraday perspective, it's a little bit easier. So the first thing I do is I typically focus more on day trading, more on getting in and out within the first hour, within the same day. And the other thing is that I'm typically a little bit just more selective with my trades, right? Because if there's markets just going crazy and you have Trump and tariffs and all these crazy things going on, then that's not my edge, right? My edge is when I know what price can do, when price is fair, when price is choppy. And so I'll typically find that there's less opportunity. So I don't change a single thing about my strategy. I maybe just focus a little bit of my attention on day trading, less on swing trading. And then, yeah, all I have to do is stick to my setups. And that's about it.
What about the types of stocks that you like to trade? Are there certain types that work you find better with triple line method, worse, particularly during volatility, of course, too? Anything like that you can give us a sense on?
Yeah, it works across everything. What I found is that it works best in, the typical large cap stocks. And mainly I trade them because they have very good volume when it comes to options. So less spreads, it's very easy to get in and out, very liquid. So things like Apple, things like Tesla, Meta, sometimes Alibaba, Microsoft, those big name stocks, especially SPY, ETF, QQQ, all that. Really the ones I focus on, and I try and kind of stay within those stocks because I know how they work and I know that they have good spreads, so I'm never gonna have to worry about like liquidity.
Mm-hmm. And another thing too that occurs to me is, again, looking back on an example chart, it seems so obvious, but in the moment when it's happening live, how are you figuring out when to enter and exit a position?
Yeah, it's a great question. So I look at trading completely different when it comes to entries and exits. So I always find my targets first, then my stop losses, then my entries. And everyone does it backwards. Everyone looks at their entry, where do I get in, where do I get in? But I do it the opposite. And the reason is that is because of my edge, right? So with triple line method, for example, the edge is that there's a high probability that price is going to go to a certain level. So example, in this picture here, right? My edge is that price is going to go from one line to the other line. And so once I know that's happening, that's where my edge is. So I start with that. I start with my targets first, say. Once I have that, I say, okay, now if I'm right, that's where I want to get out. If I'm wrong, where do I want to get out? And then I find my stop loss next. And typically I just use price action. There's a few different levers we can get into and how I find that exactly. But essentially I find my stop loss. Last, I find my entry, right? Because all trading is, at least how I do it, is I want to know where there's a high probability that price is going to go. I want to know where there's a high probability that price is not going to go. And that's where I base my trade off of. At that point, it doesn't really matter where I enter, right? As long as I'm getting a good risk reward, as long as I know where I have the right size, that's what matters to me, right? And so if I use that edge and I find my targets, my stop losses first, I put my entry, and then I simply wait for price to get to it. And sometimes it'll just go without me. That's okay, right? I'm going to miss the trade. I miss a lot of trades, but I don't care. I'm going to wait for price to come to my entry. I have a good risk reward, then I let it either get out of my stop loss or get out of my target, and that's simply it.
What does a typical risk reward payoff look like for you?
So again, for me, I do things different, right? For me, I go at a minimum 1-to-1 risk reward. So I'm risking $1,000 on a trade. I know I'm going to make at least $1,000 on that trade. Now, a lot of other traders, they say rules. They say you must have a 3-to-1, a 2-to-1. For every $1,000 you risk, you must make 2,000, 3,000. I think that's crazy, right? At the end of the day, what matters is your risk reward and your win rate. So if I know over, now like 5,000 track trades that I can have a 65% win rate using my strategy, well, a 1-to-1 risk reward is going to be profitable. In the long run, that is going to make me money. So I set that as my minimum standard. Now, I honestly could go to like a 0.9, a 0.95 and still be profitable, but I like having sake of 1-to-1. On average, what I found through my numbers is that 1.4, 1.42 is about my real average. So if I risk $1,000, I'll make about 1,400 on my winners. But obviously, each trade is different. Sometimes it's 1-to-8, sometimes it's 1.5 to 1. It really depends on the structure, but minimum 1-to-1. I don't set any other things than that. That's basically all I look at.
What about when you're actually managing the trade itself? How much tweaking of the trade once it's in motion do you like to do? I know some traders like to do a lot, some don't like to do any at all. Where do you kind of stand on that spectrum?
Zero. I hate touching the trade after I'm in it. In fact, one of the best things I did for my trading, I didn't even realize this till like year 3, year 4 of my trading, is that you can automate this. And that changed the whole game for me, because what I would do is, I'd get into a trade and I would sit there and I would start to see things. And I always say this, like, pre-trade Jordan is not the same as in-trade Jordan, right? You want to make your decisions based off pre-trade Jordan because you're thinking straight, you're thinking logically, not when you're in the trade and you have thousands of dollars on the line. So the way I do it is like, okay, I'm going to get into the trade. I'm going to set my stop loss. I'm going to set my target. I'm going to automate the whole thing. So, I don't have to sit there and watch it. I'm either going to lose this amount or I'm going to make this amount. I know that from the start of the trade. And then I walk away, like physically close the laptop, go for a walk, do what I have to do to get myself away from the screens, because I know, and every other trader knows out there, it is super addicting. A lot of people don't want to admit that, It's a very, very addicting, and it's hard to break yourself out of that cycle. So automate it, don't touch it, and I simply let the trade do what it wants to do.
Do you find you're more tempted to mess around with the trade just given all the volatility we've been seeing lately? Like, does it tempt you at all to go back on your rule here?
Well, yes and no. I mean, I'm not perfect, right? I'm human. I've been doing this 7 years, and I still make mistakes to this day, just like everyone else, right? So there are going to be times where I do just want to look at the markets and maybe want to put on a trade. I've gotten a lot better at it, though, right? The first 3-4 years, it was rough, just how everyone starts, but eventually you get to the point where you realize that you need to have the discipline, you need to be able to walk away and be comfortable with the loss, be comfortable with the win, whatever it is, and simply let the opportunities play out. So, of course, I'm never going to be 100% perfect, but I try my best to sit there, walk away, and let it do its thing.
All right, cool-headed and principled during market volatility. I like to hear it. Thank you, Jordan, for filling us in on your approach here and on your triple line method. We got a lot more to get to here, though. I want to move on to a segment we like to call hits and misses. Okay, we want to hear about your day trading career, highs and lows, and the lessons that you learned from them. Perhaps in honor of all the volatility we're seeing here, onto the downside to some degree too. Why don't we start with some of your biggest mistakes here? What was a big trading mistake that you made, and what did you learn from it?
So the biggest mistake, I mean, I've made millions of mistakes, but the biggest one was my biggest loss. It was around 2 years ago. It was on Target. It was a longer term trade, so it was like a 6-month long-term option type trade, more of an investment in a say, but I was using my strategies. I lost about $50,000 on it, and it was everything I put into the trade. And the 50,000 I'm not mad at. What I'm mad at is that I didn't use constant risk, and it's a huge mistake I made, which is whenever someone or you're a trader, you see a big setup that you feel so much confident on, right? So you remember that A+ setup I talked about, you have all those confirmations lining up. I mean, this one I had 5, I had 6. I kept seeing so many things that gave me so much confidence in this setup. And I was like, there's no way this is going to lose. So instead of, risking my normal amount, I decided to put a lot of it in, right? I put 50,000 in the trade. It was a lot more than I should have risked for that size. I was just so confident it was going to make money, and it didn't. It was a good setup. Of course, I would take it again, but with way less size, using the constant risk, and I lost. I paid the price. So really the biggest lesson to come from that is you just got to stick with constant risk, right? Even if I'm day trading, again, if I have a 65% win rate and I have a 1-to-1 risk reward, risk 1,000 to make 1,000 in every trade, I am guaranteed to make money. Like the math adds up where you're going to make money over time, right? But if on one trade I risk $500, the next trade I risk 700, another one 300, another one 2,000, then my whole edge is gone. Everything disappears, and there's no statistical edge to make money using that strategy. So using the constant risk, the same exact risk on every trade, is super, super, super important, and I paid the price not doing that.
Right. Okay. So consistency is key here. Well, let's end this segment on a high note, though. What about one of your biggest day trading successes and what you learned from it?
Yeah. So my biggest trade, I'll do percentage-wise because I think it has more merit. It was about a 2,800% gain, so about 28x return on it. And I only had a few sides in it, but that one, I have to say I got luckier. I'm never going to say I'm a predictor of everything, and I knew this was going to happen. But that was trading. That was basically getting in on an early opportunity. So that one has to do with Bitcoin, right? And so I knew Bitcoin early on. This was way back, like 2016, not 2016, about 2020, whenever that second kind of huge run-up came through. I had a feeling Bitcoin was going to go up, right? My edge was telling me it was going to go up, and I didn't want to just buy Bitcoin because I saw like maybe I'd make a 3x, a 4x, a 2x if I was right. And so I knew that I could utilize options. If I could utilize long-term options on a Bitcoin stock, I can make a lot more. So one of the tickers was called Riot. It was a Bitcoin mining company. And way back when Bitcoin ripped its first time, I saw this stock went crazy. So I said, okay, if this thing goes again, this thing can go crazy. I got in the stock at $3. I got it with the options. So I got in like $3 options, $5 strike options. I think I got the $10 strike options. This thing just ripped. I got in at the very best time, like right before it ripped, got in, sold a good chunk, hold a few runners. My final exit was at 2,800%. And I remember if I held on to it and it kept going more, it would have been it peaked at about 7,700%. So it made a 77x return, and it was like a 2-month trade. So, being in the right opportunity and using the right leveraging techniques, like, if I were to just buy Bitcoin, I would have made a 2x. Because I went with the options, I made a 20x. right? And it's the same exact play, the same exact setup. So being able to utilize that was very smart. And it's obviously, of course, I wish that one I also made the mistake of going all in, but I didn't do that. So win some, you lose some. It is how it is.
I think you walked away with a pretty good result, all things considering. So, I mean,
Right.
that's pretty good. But yeah, I mean, of course, with options, obviously you take on some leverage here. The upside can be greater, the downside can be greater too. So there's obviously a trade-off to consider there. But in this case, it certainly worked out for you here. Okay, well, so thanks for playing along with that, Jordan. We've also got another segment we like to call Hot Takes. Okay, we've heard a lot of interesting perspectives on our program in the past, and I want to bounce some of those ideas off you, see if you agree or disagree, and why. So we got a first idea here. This one comes from Shay Huang from The Humble Trader, and she says she doesn't use the volatility index or the VIX when trading.
I know
I
a lot of
agree.
options trader who trade around the VIX. Let's say when the implied volatility is really low, then they'll take certain option trades. I don't do that. At least the active momentum trades I do take for those the day trading and swing trading, I love volatility. So I guess if VIX is really high, I guess that I'm actually would take even more trades. I know the question probably came from the fact that you are scared of taking certain swing trades when the VIX is high. But for the way I trade, it's not a big concern.
All right, so Jordan, you were so emphatically in agreement with this statement that you couldn't even wait for the clip to be played before you agreed. Tell us why VIX is not something that you care about when you're trading.
Well, she actually said something else I disagree with. But when it comes to VIX, yeah, it's just volatility, right? I have my strategy. I have my edge. If there's an increase in VIX, increase in volatility, it's not going to change anything. Now, I think she said something about, like, if VIX is higher, I'm going to take more trades. I don't necessarily agree with that, right? All trading is based off opportunity, right? If there's a week goes by and there's no good setups, I'm not going to trade. So maybe her setup will, just present more opportunities in a higher VIX environment. Then sure, you can take more trades. But for me, all an opportunity based. So if I don't see my setup, I'm not going to get into a trade.
Right, just business as usual, just reading the tea leaves on the charts there. Okay, we have another idea here. This one is from options day trader Zach Hartley, and he says that he likes using a trailing stop loss order. Says it's one of the most important risk management tools that day traders should use. Let's hear what he has to say.
You enter a stock at $10 and your stop loss is at, let's just say $7. That means your take profit might be at $16. Well, if the stock moves up to $14, you now have a stop loss at 7 and a take profit at 16, which means you are going to make 2, but you're risking $7 here. And that is a terrible ratio. Obviously, nobody would take that trade. And so what I do is, as the trade works in my favor, I move that stop loss up to try and lock in profit, but also reduce the risk on that trade, because that risk to return ratio trades as the stock moves or as the option moves. And so it's really important to either have a way to adjust your stop loss using a trailing stop loss, or to adjust it manually periodically, depending on how the trade is going.
All right, so Jordan, earlier in our conversation, you told us that you don't really like to manage trades when you're placing them. So what do you think about Zach's approach here of using a trailing stop loss, or even just manually adjusting a stop loss during a trade?
So I'm in the middle of it. And the reason for that is you have to do whatever works best for you and also what works statistically, right? So for example, if he back tested a strategy or forward tested a strategy and he did it one with trailing stops and one without, and he found that his trailing stops one made him more money, then he should go with that. I tried it. I tested everything over like a 2-year period. I found it doesn't work for me because A, it didn't make me more money, and B, if I'm sitting there, manually adjusting my stops, I'm still looking at the trade, I'm getting emotionally involved. And again, I want to stick with pre-trade Jordan, right? That's where my best decision making is. So I found it doesn't work for me. That works best for me. There are some strategies where it probably does work better to have a trailing stop, but it really depends on what you're trading and if you have the numbers to back it up.
Okay, so every trader is different. Interesting to hear your perspective there. The pre-trade Jordan, though, message I think is a strong one, right? Try to take the emotion out of it as much as you can here. Thank you very much for playing along with that segment there, Jordan. We've also talked a lot about in our conversation here about how you like to interpret a stock's price action to find those trading opportunities. So on that note, I want to pass it over to my colleague, Jason Natick. He's going to give us a look at how to explore price action in the TD Active Trader platform.
I hope everyone is enjoying the show. Now let's jump into TD Active Trader for a quick tour around the charts where I'll show you how to make 4 easy customizations. All right, the first customization, this is going to be around candle aggregations. Noticing here we are on a 1-day candle already. Looking towards the top, just to the right of the buy sell buttons, this 1D lets us know we're on a 1-day candle. We give that a click, noticing there's a drop down menu where we've got preloaded many of the most common aggregation periods that traders like to use. But hey, TD Active Trader is not a one size fits all experience. If something's not there for you, choose the custom selection at the bottom, type in the aggregation you'd like to see, hit the enter button, and your selection will appear for you each and every time that you click on that menu. All right, customization number 2 is very similar. This time we're going to be looking at time periods. This is going to be available in the bottom left-hand corner. Once again, many common selections already here, but we can add to this list. We're going to do that by clicking on the plus button towards the bottom of the screen. Let's go ahead, well, 1-year chart is already there. Let's go ahead and add a 5-year chart. So let's drag the aggregation out to, let's choose that so it's on a daily candle. And then lastly, the date range, we're going to move this so it's out to 5 years. All right, so after we go ahead and have that set and ready to go, hit save. The 5-year is available for us to choose each and every time, and the chart is conveniently updated with that information. Okay, the third customization, that is going to be around adding volume to your charts. To get that accomplished, look towards the top of the screen where the icons are. The last icon on the right is chart settings. If we give that a click, towards the bottom of the menu, just all you need to do is simply check the volume box. Volume is available in 2 separate displays, either overlaying, which is on the chart now, where the volume bars are overlaid with your chart candles, or if you'd like to have it segregated, you can choose separate, and it'll be displayed in its own box beneath the price chart. All right, now the fourth and final customization is around adding drawings to your chart. Towards the top of the screen, to the right of where we set aggregations, is the drawing menu, but we've also got it conveniently located in the left-hand margin of your screen. You can click the double chevron at the top of the menu to expand it so you can get a full look at all the names of the drawings. There's your simple trend, price, as well as timelines that you can add on to your chart. But if you scroll down, there's many more unique features, such as adding text onto the chart, and there's some more advanced drawings, so your arcs, your circles, and for the Fibonacci fans out there, don't worry, these are here for you as well. All right, but going back, let's just add a simple trend line on so I can show you how nice and easy that can be. Go ahead and select the drawing. I'm going to minimize the menu, and to get the drawing onto your chart, all we'll need to do is click once and then drag your mouse where you want it to go. If we're creating support and resistance points, we're looking to connect as many dots along the way, and click it a second time to complete the drawing. But there's more to it. We look at the top of the chart, there's this menu, that's appearing after the trend line is here. This is how we can edit features on the trend line. We can change the color. We can change the thickness of the line. In the gear is where some really interesting customizations come to play. You can extend the line to the left or the right, but one that I really like to use is this show percentage price change. By clicking that, let me go ahead and close the menu and show you where that comes in. We can see now on the chart, during the duration of the trend, this particular ETF is up over 66%. So really nice and easy to get more information. All right, if you want to learn more about charts or really anything in the platform itself, we've got the education tab that's here for everybody at the top of the screen. You can scroll through videos on really any of the really interesting features. You can either view those here in the platform, or if you want to join us on our TD Direct Investing YouTube channel, there's lots of great information there. And there you have it, the robust charting package available for you in TD Active Trader.
I appreciate that, Jason. Jordan, we are at the end of our interview portion here, but we're not done quite yet. We have our viewer Q&A to get to here. So are you ready to hear what our viewers want to know more about?
I'm ready. Let's get into it.
All right, we got a first one up here from Dina Maria. And Dina Maria says, do you trade only in selective shares? How do you select the shares to monitor?
To be honest, I don't even know what selective shares are. I've never heard of that. I just trade stocks that I know. I typically trade options. I trade futures. I do have some scanners that I use to find the stocks that I will trade. But when it comes to what I typically trade right now, it's mainly options, and rarely I'll typically trade shares.
Okay, good to know here. Let's keep things moving along here. Ara has a question here. Ara says, what is the timeline on your chart that you normally look at when doing day trading?
Yeah, so it goes back to the time frame, right? I'll typically, to make it easy, I'll look at the 1 minute, sometimes the 5 minute, but it doesn't matter, right? I could tell you I look at the 3 minute or the 1.5 minute, and it's not going to change anything, right? You're still seeing the same price. What matters is zooming in and zooming out. right? So when I'm trading on the 1 minute, I'm still zooming out to see the past week of price action. I'm still zooming out to see the past month. I still want to see the past 6 months. And so that's what I want to look at when I'm taking my trades. And there'll be times where I'm looking at, I'll identify that, off a 6-month timeline, we're in an area where typically people would want to buy. And that will influence, even if I'm looking at the 1 minute chart, of where I want to sell and where I want to buy. So you want to have all context in line, but whether you're looking at the 1 minute, the 3 minute, 5 minute, it doesn't matter. You're still seeing the same price action.
Okay, good perspective there for Ara there. Daniel has a question. Daniel says, I've been paper trading for 6 months. I feel strong and have been profitable, quote unquote, paper money here. I want to start off with $1,000. What do you think the next step for me should be?
I think you should start trading live. I think you should have honestly stopped paper trading 6 months ago and started right with a live account. Because a lot of people, and I did it too, right? It happens. But there's a huge difference between, trading with paper money on a screen that doesn't mean anything versus trading with real money on the line. Even if it's $5, even if it's $10, doesn't matter. There's a huge difference. And I tell people from the start, you need to go right to live money, even if it's a little bit, because you have to feel those emotions. Emotions are 80% of trading. If you don't feel that and you stick with paper trading, it's going to be completely different. So as soon as you can, get started trading live money. Again, you're probably going to lose money. Most people lose money like forever, and a huge chunk lose money, especially in the beginning. So have that in mind. Start very, very small, but you need to trade live to get those emotions in play.
Yeah, I've heard that losing money early on is sort of like the tuition that you pay to the market in order to graduate, I guess, if you will, as a day trader here. So something to keep in mind there. Get right to the live trading, so says Jordan. Gui has a question here saying, if you are wrong after entering a position, the stock drops, how do you set up cutting the loss? And you sort of touched on this earlier, Jordan, but elaborate a little bit for us.
Yeah, I mean, I'm wrong 35% of the time, right? I'm wrong a lot. So, but again, I go into every trade with my targets and my stop losses before the trade even happens. I know exactly how much I can lose, and I know exactly at what price I want to get out. And there's you have an edge. You should have a strategy of where when price gets below this level, then my edge is gone. And that's how I trade too. And then, going back to that, I see it a lot of time too. People will trade with random stop losses. They'll get into a trade and they'll say, okay, when price gets here, I'm going to get out for a loss. But it makes no sense, right? They just put a random level on the screen and say, okay, I'm going to be wrong. But you need to trade off logical stop losses. You need to have a place where you say, if price gets below this level, then that means the edge is off. And there's a very high chance this trade is not going to work out. Because you never want to stop out at the wrong place, and then price just keeps going back in the right direction, and then you would have made money if you had your stop loss in the right place. So put it in the right place, automate it, don't touch it. That's all you really need to do.
And we often talk about the benefits of automating your investing, so the same applies to day trading, I guess, too, right? Automate as much as you can here. Sergey has a question here. This one is, what percentage of your cash should you invest in one stock to mitigate the loss?
Yeah, I mean, you want to be diversified, right? If I'm day trading, let's say I have $50,000 in the account, I may take positions of $3,000, $5,000, sometimes $15,000. But what matters is your risk, right? That's the only thing that matters. So, even if I have a $50,000 account, I could put $40,000 of that into one trade. But as long as I know I'm only risking $500, it doesn't matter, right? So I'm protected. As long as you know your stop loss and how much money you're risking per trade, that's what matters. Now, it looks like from the question you're talking more about investing and setting up a portfolio. I don't have a specific number, but you want to be diversified. 10 stocks, 15, 20 stocks. You get ETFs that gets you in baskets. The more, the better, right? You're never going to be disadvantaged from having a better diversified portfolio.
Right. Diversification, it's often called the only free lunch in investing, and certainly risk management is probably the only free lunch in day trading, quite frankly. So really appreciate you taking questions from our viewers there, Jordan. Really great perspective here. Thanks again for joining us. And of course, to our audience too, we appreciate you tuning in as well. That's all the time we have for this week's show. Make sure you check out next week's episode. We have Robbie Michnick from BlackRock. He's going to explain why Bitcoin may be a valuable addition to a long-term investor's asset allocation. It could be something that helps your risk-reward profile. He's going to tell us why that makes sense. and something that you might want to consider. For now, though, that's all the time we have. For everyone at Inside Investing, thank you so much for watching, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.